Hello and welcome. You're watching Lots Trades. I'm Agam Vakil, and in this show, we'll take you through all that is happening in terms of stocks which are buzzing in trade on account of volumes, bulk deals, and block deals. But in this show, we're also talking about earnings. But before that, let's take a quick look at how things are panning out as far as markets are concerned. The Nifty is very, very quiet, absolutely flat, no change. But within the Nifty, we are looking at a lot of traction. So we do have State Bank of India, which is the top gainer on the Nifty at the moment. And we have seen advances of nearly 3.5% there. JSW Steel is the other one, which is up around 2.5%. And Britannia, which also announced its earnings, which is also advancing in trade. But that's the constituents of the Nifty. Clearly, we have those advancing more as compared to perhaps those which are weighing down on the indices. And a little bit of an up move for some of your insurance companies too. HDFC Life, for example, is up around 1.9%. We also have gains in Grasim, Ultratech Cement, Nestle, all of them up and about and advancing in trade as far as the markets are concerned. But let's talk about earnings then. And we have earnings from Welspun Corp, which has in fact posted a multifold jump in its consolidated net profit. And it's also seen a substantial jump as far as its revenues are concerned. Let's get in, well, the management of the company. We have Percy Birdy, the CFO of Welspun Corp, joining us on the show right now. Percy, good afternoon. Thanks so much for joining in.
Thank you, Agam.
Can you take us... Right. Percy, can you take us through the quarter, what's really gone so well for the company, and whether or not this level of revenue on a quarterly basis is now the new normal?
Sure. So, Agam, what's been happening in Welspun Corp is that we are really transforming from a mild steel line pipe company, which was basically large diameter pipes, going into just oil and gas and water applications. We are transforming into a conglomerate of companies and businesses. And the newest businesses that we have added in the last few quarters has been the ductile iron pipes business, which is one of the sunrise industries. So we put up a greenfield manufacturing plant at our facility in Anjar in Gujarat of 4 lakh tons capacity. And this is the plant which has been ramping up. And what numbers you are showing now in the December quarter and what you will see in the next few quarters going forward will be coming due to the ramp up happening at the ductile iron pipes facility. In addition to that, we have also made acquisitions. We acquired Sensex. Sensex, as you know, it's a household brand name into water storage tanks business. And though it's relatively small in value when we acquired them 1 year ago, our plans for them are absolutely grandiose. So we are going to use the Sensex powerful brand. We are going to use their distribution network, and we are going to make it grow multifold. Of course, it is going to take 3 or 4 years for us to make this happen. And we'll be setting up new capacities in plastic tubes as well across the pan India. But these are the 2 pillars of growth that you will see going forward: ductile iron pipes and Sensex.
Right.
Plastic pipes.
Right. And Percy, from what I understand, that FY25 is also where the focus will be on these 2 specific segments?
That's true. These are our growth pillars.
All right. So can you tell us about investments which have been lined up, and what kind of capital expenditure are we expecting in terms of expansion with respect to these 2 segments?
Sure. So for ductile iron pipes, we are expanding our capacity at Anjar, as I spoke earlier. Our capacity was 4 lakh tons per annum, which we are enhancing it by another 1 lakh. So it will become 5 lakh tons per annum. This announcement was already made in the past, so it's in the public domain. And the capital expenditure on this is about estimated at about 300 crores. In addition to that, yesterday our board has approved a DI plant, a ductile iron plant in overseas. That's in the Middle East geography. Right. And that's going to be another 150,000 tons of DI pipes to be planned to be set up there at a investment of close to 500 crores. Then Sensex. Sensex is where we had made an announcement in the past about setting up a plant in Telangana. And now it's not only Telangana we are looking at. We are looking at setting up Sensex plants for plastic pipes, especially. Plastic pipes, that is HDPE or UPVC, OPVC, these pipes and water storage tanks facilities across the length and breadth of the country. So we'll be going to 3 or 4 locations for Sensex also in the next 2 years' time. So this also will be a capex, and approximately you can say these numbers put together Sensex, as well as the DI pipes, what we have already announced, these will add up to close to 1600 crores. So 1600 crores will be invested over a period of, I would say, 2.5 years.
All right, Percy, so in that case, if you can give us an idea about, well, going forward, what sort of geographies are you working with? Where are you currently, well, what markets are you currently present in? And, well, what can we look forward to going forward?
Sure. So we are currently present in India, US, and Saudi Arabia. That's in the large diameter pipes. In India, we have also ventured into ductile iron pipes. We spoke of that a while ago. And Sensex, which is in water storage tanks, and we will get into plastic pipes using Sensex, will also be India-based. However, there is a tremendous export potential also from India. So whether it is DI pipes, whether it is Sensex, whether it is even the large dia pipes, we have been exporters for the large dia pipes as well to markets like Middle East or Southeast Asia, Australia. So our physical presence, manufacturing presence is there in India, US, and Saudi, while we export to multiple geographies.
Right. Percy, my final question then is about the order book. What kind of orders are you working with right now? And what's in store in the pipeline in terms of your conversations with potential clients going forward? Can you give us a picture there as well?
Sure. So our order book, which is largely comprising of India and US, is about 575,000 tons at the end of December. And in value terms, this comes close to 7,000 crores plus. This is without the Saudi order book. Saudi order book is phenomenal. They have an order book which will take care of their mill bookings for the more than next 2 years. So that's absolutely fantastic position in which our Saudi associate company is. Looking at the DI pipes in India, which is our new business and ramping up more, there also our order book is taking care of the next 9 to 10 months of supplies. And we are going to increase this order book as time goes along further. So DI, as we know, it is a sunrise sector. And we are very confident that this will fuel our growth, ductile iron pipes business in India.
Okay, Percy, we'll leave it at that. Thank you so much for joining us and taking us through the quarter's numbers as well as what we can expect from the company. Well, that's the management of Welspun Corp and well, a significantly improved quarter where we've seen revenues double and profits has risen manifold. But from there on, we shift focus back to large trades. And the first one on our list is EIH. We have my colleague Anushi who's joining us to give us an update on the same. Anushi, what's going on with EIH?
Right, so EIH was in focus after it hit an upper circuit today with the stock gaining over 20%. But from there on, we did see that it has cooled off from those levels and it's currently about 15 to 16% high. So this was on the back of the results that came out yesterday. So in which we see the revenues seeing about a 26% growth with EBITDAs seeing about a 55% growth. Margins over here is a particular focus with margins inching up to about 44% compared to 35.6% earlier, and even the net profit saw about a 50% rise. So a couple of reasons that support these sort of numbers. One is the occupancy, which went up about 2% at 79% compared to 77% earlier. Even the average room rates that the hotels charging, they are seeing overall industry-wise also there's a healthy growth with EIH recording about a 19% growth over here at about 19,985, which has both the occupancy and ARR has resulted in a better revenue growth for the company. Again, what I want to shift the focus on is the company's prudent strategy on debt reduction, which has resulted in about a net cash positive position since the June 2022 trajectory. So if you look at the right now, the net cash position, that is about 684 crore compared to 256 crore of last year. For the future, I want to highlight some of the key triggers that we can keep a watch out for. One is the foreign travel arrivals that have still not inched back to the pre-COVID level. So again, it provides some sort of a growth opportunity here. Again, the company's expansion plan of about adding 50 hotels by calendar year 2030. Overall stock performance-wise, the company has seen about a 143% gain in just 1 year. And if you look at the volumes were high about 9 times its 30-day average now. So that's all on EIH for today.
All right, Anushi, thanks so much for getting us that update on AIH. Of course, it's running today and largely on account of volumes for the many reasons that Anushi has already mentioned. But there is another stock which is also doing very well in trade today, and that's Action Construction Equipment, which is also up and about. But this time we have Mihika, who's going to give us an update on this one. Mihika, what do you have for us?
Yeah, so the stock has hit an intraday high of 18.14%, and year to date also the stock has shown strength. It's up 32%. Now volumes were over 8 times its 30-day average, with the total volumes at 21.1 lakh, and the buyers were almost 1.5 more times than the sellers. Now the surge in price is mainly due to the Q3 earnings. Revenues were up 35.6%. EBITDA was also up 64%. Margins expanded up around 230 basis points, and the net profit was up 98%. The revenue growth was driven by higher volumes, better product mix, and the company's focus to procure more high-value equipment orders. Significant growth in their cranes and construction equipment segment, while there was a degrowth in the agri equipment segment. And they had a 228 basis point margin expansions due to better operating leverage, cost efficiency, and expansion. Now, key sectoral growth drivers for the stock from the medium to long term is one, the PM Gati Shakti plan, which is going to influx around 100 lakh crores towards the national infrastructure. Also, the allocation of 1.4 trillion US dollars under the national infra pipeline, which ranges from FY19 to FY25. Now, this higher allocations will help the sectors that the company does cater to. This includes infrastructure, railways, roads, ports, and agriculture. Additionally, it also has some targets in terms of opportunities. It does want to tap into the defense sector, also improve and their export contribution to total revenues, as well as increase the utilization levels.
All right, Mihika, thanks for getting us that insight as far as Action Construction Equipment is concerned. And it's been surging for many, many reasons, as Mihika has elaborated. But on that note, it's time to slip into a short break. But on the other side, we get you another management and also more stocks. Stay tuned in. Welcome back. And now we talk about Max Insurance Company, which has received an approval from the Insurance Regulatory and Development Authority of India for an infusion of about 1,600 odd crores by Axis Bank. But moreover, we've also have the earnings from the company coming in, and it certainly looks like a very strong quarter coming through, because of which we are seeing advances today. But we have with us Prashant Tripathi, CEO and Managing Director at Max Life Insurance at the moment. Prashant, good afternoon. Thank you so much for joining in. I want to start by taking a look at the quarter gone by, and well, we are looking at a lot of strength. Can you tell us what's driving APE growth for you, and will that continue to be in around mid-teens?
It's a part of chosen strategy. Actually, thank you for having me. Part of our chosen strategy since the beginning of the year, we have been telling that we are making investment in growth, and we will try to drive APE growth. So we have been working with our proprietary channels, especially, and a large part of our growth is actually coming from prop channels. If you look at our agency, our direct sales force, our e-commerce channels, all of them are just firing at unprecedented pace. For the quarter, for example, our agency grew upwards of 50%. Our direct sales force, sales grew by more than 40%. E-commerce sales grew by more than 60%. So that's been a big vehicle for growth. But in addition, we also have been working to enhance the number of partnerships we've got. We signed up this year about 25 new partners, 6 of them being banks. So they have also started to churn numbers. And overall, the momentum that is there in the business is very strong, as a result of which, for the quarter, our adjusted sales growth was about 18%, which is double the growth rate of private average of 9%. A number of policies are growing so far 20%. So all of growth is coming quite secularly from the number of policies that we're writing. Sure. In addition, the group business is also growing quite robustly. The credit life business is growing last quarter more than 100%, YTD 56%. So all in all, very good momentum.
Right. Prashant, I want to talk a little bit about your margins as well. And I understand, if I understand correctly, a lot of that will depend on your product mix. Your margins, of course, have been within a certain range. But can you tell us about what we can expect going forward? Based on your product mix, can we expect the company to maintain these margins as well?
So, I always mention that last year was an aberration because of a certain product type, non-par being the most important product that's sold in the industry. But this year we were expecting to fall back to the FY 2022 range, which was close to 27. Very happy to share that by every passing quarter, our margin profile is enhancing. We finished the quarter at about 27.2%. And the forecast that I've been giving was in the range of about 27%. So we are round about there. We are not anticipating a margin above 30%. We are not going to be in that range. Actually, it has to be a balance between growth as well as margin. And looking forward, we definitely expect that YTD margin should get enhanced, should definitely fall in the range of 26 to 27%.
Right. And can we expect the value of new business to grow at the rate of 20-25% over the course of the next 3 to 5 years?
Absolutely. I think for last few years, we were growing our VNB because of growth in margin. The margin, once it plateaus at around 27-28%, it grows very little from here. A large part of that will happen because of APE growth. And we are seeing unprecedented good momentum in the APE growth. Our APE growth is 23%, perhaps highest amongst the top 10 players. And the objective is to continue to grow AP. There are many other initiatives which have not come to fruition now. And with some momentum building in our banker space, we are reasonably sure that we should be in the range of high teens to 20 plus kind of AP growth as well as VNB growth.
Okay. Just a quick question on Axis Bank as well. I believe that this is about 1%, additional stake left for them to be, being acquired. Would you like to diversify beyond Axis in a big way? I know that there is a huge ownership now already, but can you give us an idea about how you are looking to diversify here?
So basically, firstly, in terms of equity ownership diversification, we are not anticipating beyond of this. So Axis will go up to 20%. If they get regulatory permission, maybe at some future stage, but that's not known at this point in time. So for the time being, Axis will go up to about 20%. So 19 with this injection, and they will do further injection to go up to 20%. And, from sales diversification perspective, right now, close to about 51% of our sales comes from Axis Bank. We're definitely acquiring new partners so that we're able to diversify more and more beyond of Axis Bank. And that's quite likely we will be able to do that.
Right. So actually, my next question was to do with Axis contributing to your overall banker channel going forward. And also, if the infusion would mean anything to your solvency as well going forward.
Absolutely. With the second question first, the solvency will improve because we are going to take 1,612 crores. It's a primary, so it comes in the company, and our solvency will move up by 35 percentage points. So it will go up to, from the current level of about 180, expect that to go in the 215 kind of range, which is good, and it will give us enough fuel for growth. As you know, we are growing quite expeditiously. With respect to Axis contribution in the business, we expect that to remain robust. Axis has been a large partner for us, and the color of the relationship has changed now. They are promoters. They sit in our board. They are part of our strategy. And as growth revives at Axis Bank with respect to insurance sales, we expect to be in the range of about 65 to 70% of their counter. So it's a matter of time, and I'm very hopeful that as the next quarter comes, this quarter, we will start to see growth at Axis Bank also.
Okay, Prashant, we'll leave it at that. Thank you so much for joining us and taking us through the quarter's numbers as well as what we can expect going forward. We wish you the best for the future.
Thank you very much. Thanks for having me.
Well, that's the management of Max Financial Services, and of course, where the core focus is insurance. But from there on, we shift focus back to all that is buzzing in trade. And one of the stocks that we are mentioning and focusing on now is WMart, which is also up and about. Let's get in my colleague Mahima to give us an update on this one. Mahima, good afternoon.
Good afternoon, Agam. So as you rightly mentioned, it's been buzzing in volumes today. The volumes are at 22.08 times its 30-day average, and it did touch an intraday high of almost 15%. Now, this is on the back of very good Q3 results. WMart has now come back to profitability after 3 consecutive quarters where they incurred net losses. If we talk about revenues have been up 14%, EBITDA has been up around 15%, and net profits have jumped over 40%. Now, what has led to this growth is because of good festive demands, and because of which their footfall grew by over 23%, and also the like-for-like sales have seen a growth of over 4%. And if we talk about the key highlights of the Q3 results, they added 20 new stores in this quarter. Their Lime Road stores net losses have also reduced by 29% sequentially, and their other expenses have gone up by 25%. However, their working capital has improved, and their inventory has decreased by 12%. So overall, it has been a very good Q3 for WMart.
Certainly, and the price reaction speaks for the kind of quarter that a lot of the investors are making of it. Mahima, thank you for getting us that update on the results as well as the volumes, which are certainly buzzing as far as WMart's concerned. And from there on, we talk about the chemical sector. We have Navin Fluorine, where, it's been under a tad bit of pressure in today's day of trade. We're going to get in Varsha to perhaps give us a better explanation of why that is so. Varsha, good afternoon.
Good afternoon, Agam. So as you rightly said, so stock is down 5% in trade today. And if you see last 1 year, company has given negative returns to shareholders. Now, we all know what is happening with specialty chemical companies. Now, if you see the volumes, they're trading at over 9x is 30-day average. Now, stock is under pressure. This is led by the earnings. So company posted weak earnings. So if you see, profit did beat estimates. Now, we'll see in a bit why profit profit beat estimates. But if you see, revenue was down 10%. Now this was on the back of the revenue was impacted due to slower ramp up in HFO plant and pricing pressure in R22. R22 is a gas which is used in ACs. Then the other reason why the revenue was impacted was deferral of campaigns and inventory destocking in specialty chemicals. Also, there was postponement of sales for key molecules in CDMO business. Now, CDMO business is a kind of lumpy business, so this lumpiness was actually expected for Navin Fluorine also. Now, if you see, revenue was down 10%, EBITDA was down 50%, but net profit was down only 26%. Now, this is on the back of exceptional items. So, company did sell a land for 52 crore. This is the reason why net profit was only down 26%, while EBITDA was down 50%. Now, if you see the capex, they have approved capex of almost 288 crore for their new GMP facility and 84 crore for expansion of HFC capacity, while FY25 would deliver strong earnings on the back of deferrals from previous year and new projects, and company is really good when it comes to complex fluorination space, but near-term commissioning delays and no clarity on leadership would be a near-term overhang on the stock. There are two brokerage views for Navin Fluorine. So if you see, Jefferies have a hold rating while Citi has a buy rating, and both of these brokerage has reduced the target price. Now this is on the back of they expect delay in delivery schedules in specialty chemical. Also, growth priorities of new MD is to be awaited.
Right. So a lot of challenges are very evident as far as Navin Fluorine is concerned. Prashant, thank you so much for getting us all those details around this particular chemicals company. But with that, we will completely run out of time on the show. So, well, just signing out for now, but don't go anywhere. Lots more lined up, specifically India markets close on the other side of this break. Stay tuned in.